Hello everyone. In this video I'm going to continue my discussion about adjusting entries. And we're going to see some examples of the 4 different types of adjusting entries plus the depreciation. So the first thing that we're going to start with is accrued revenues. And let's see this example. It says, assume that Net Solutions, which is the company that we've been using since chapter 1. So assume that Net Solutions signed an agreement with Dunkner Company on December 15th to provide services at the rate of $20 per hour. As of December 31st, Net Solutions had provided 25 hours of services. The revenue would be billed on January 15th. So as you can see here, they provided the service, they didn't even send the invoice yet. They didn't bill the customer or the client. So in this case, we have to record an adjusting entry to say that we actually earned the revenue because we provided the service, but we have accounts receivable, which is something that we expect to collect from our customer. So you see here on December 31st, we debit accounts receivable and then we credit fees earned. And that's an adjusting entry that's going to be used whenever we provide the service without receiving the cash. So we see here how it affects the accounting equation. You can see that accounts receivable under assets go up, and then for fees earned or revenue, which has an indirect impact on stockholders' equity, but it's a positive indirect impact, would also go up. So this is one of the adjusting entries where we expect to see accounts receivable. So I want you to remember it's very straightforward. We debit accounts receivable and we credit the revenue. The 3 conditions are met. We have December 31st, which is the last day of the year or the period. And then we have accounts receivable, which is a balance sheet account, fees earned, which is an income statement account, and we don't have cash involved. So these are the 3 conditions that should be met whenever we have any kind of adjusting entry. So what if the accountant forgot to record this kind of adjusting entry? We call it an omission of the adjusting entry. What would be the effect of that? What would be the consequences? So the adjustment for the accrued revenue of $500 is not recorded. The income statement and balance sheet prepared on December 31st would be misstated. So you can see here that under the income statement, if we don't record the revenue, then, which is the fees earned, the revenue would be understated. In other words, would be less than it should. And if the revenue is understated, net income would be also understated. Expenses would not be affected. So you can see here it says expenses correctly stated. But your net income would be understated. On the asset side, because we're not going to record the accounts receivable, then assets would be also understated. And liabilities would not be affected. Stockholders' equity, because it's related to net income and revenue, so we expect that stockholders' equity would be also understated. So the impact of the omission of this adjusting entry would be an understatement of revenue, an understatement of net income, understatement of assets, an understatement of stockholders' equity. Let's see another kind of adjustment. And here in this case, it's for accrued expenses. Again, one easy thing that you can do is translate the word accrued to unpaid. So these are unpaid expenses. These are expenses that we incurred, but we haven't paid yet. So Net Solutions pays its employees bi-weekly, which means every other week. During December, Net Solutions paid wages of $950 on December 13th and $1,200 on December 27th. As of December 31st, Net Solutions owes $250 of wages to employees for Monday and Tuesday, which are December 30th and 31st. Because remember, the last time they paid them was December 27th, which was a Friday. Then they had the weekend, Saturday and Sunday. And then the employees worked Monday and Tuesday, which are December 30th and 31st, but they're going to get paid not this Friday, but the following Friday. So you can see here that they worked for us, we incurred the expense, but we haven't paid them. So we have wages payable. So as you can see here, we debit wages expense, and we credit wages payable again on December 31st, and the values were given to us as $250. So under wages expense, you expect the expenses to go up. So we have an increase in wages expense. And under wages payable, we have a liability, and it's also going up. So, again, that's another example for adjusting entries needed for accrued expenses, whenever we incur the expense, but we haven't paid it yet. So we have to record what we incurred, even though we haven't paid it. Typically, companies, they know whenever they pay, because a pay is a real transaction. But when people work for us and we don't pay attention to that, then at the end of the period, we have to check and see how much we have to pay them or how much we owe them. And that's going to be the amount of wages paid. So Net Solutions paid wages of $12,750 on January 10th. This payment includes the $250 of accrued wages recorded on December 31st. So now we're not recording an adjusting entry anymore, but we're recording a real transaction that is affected by the amount that we owe to our employees. So see, we paid our employees now for the 2 weeks, but out of those 2 weeks, which include 10 working days, we had 2 days that were in the month of December where the employees worked for us. However, we haven't paid them, and we had the wages payable. And these are the $250 here. So now we're getting rid of the liability. And remember, liabilities, they have a credit nature. So whenever we want to cancel them, we debit them. Because why we're canceling them? Because we're paying off the entire balance. We're paying our employees the balance that we owe them. So we debit wages payable for $250. And then they worked for the other 8 days, and that's directly wages expense. But these are related to the month of January. So we have $1,025. That's wages expense. Remember, expenses are debit. They like to be recorded on the debit side. And then we have cash on the credit side for the total. So out of the $1,275 that we paid on January 10th, $1,025 are related to 8 days of, 8 working days of January, and then $250, which are 2 working days for the month of December. So in this chart here, we can see how the days are calculated. You can see that employees are getting paid every other week. So they got paid on the 13th, the 27th, and the 10th. So for the 13th, it's not a big problem because we're paying them for 10 days or 10 working days of December, and they got paid here, I think it says $950. And then for the other 2 weeks or the other 10 days, they got paid $1,200. Okay, and then we have 2 days that they worked for the company for the month of December. However, they didn't get paid for these. Okay, and then they worked in January 1st all the way till the 10th. You can see that these are 8 working days. They got paid for that at $1,025. And then we have $250 that are related to the 2 days of the month of December. So the actual cash payment was $1,275, which is for January 10th. But actually what's related to the month of January, only these 8 days, which are $1,025, and $250 are for these 2 days. And that's how we got this journal entry where we debited wages expense for $1,025, and these are for the 8 days or 8 working days of January. And then the wages payable, which are the liabilities that we owed towards our employees for the 2 days of December, the last 2 days of December. And then the full payment was for the 10 days. And that's how it looks like. Okay? Of course, as an employee, I'll get on the 10th, my paycheck for $1,275. Of course, this is under the assumption it's only one employee. So I got my payment for $1,275. But in reality, my employer expense for the month of January is only for 8 days, and it's 2 days that they owed me for the month of December. So what is the effect of omitting this adjusting entry? If the adjustment for wages, $250, is not recorded, the income statement and the balance sheet prepared on December 31st would be misstated. So let's see what's going to happen. Let's look at the income statement. If I didn't record the expense, of course, revenues are not going to be affected, but expenses would be understated. And if expenses are understated, net income would be overstated because expenses, they have a negative impact on net income. So if I don't record an expense, then I would overstate or exaggerate on my net income. How about the balance sheet? Assets are not affected because we don't record any asset here. But remember, we record the wages payable. Wages payable is a liability. And the wages payable would be understated because if we forgot to make this adjusting entry, so the liabilities would be understated. And because of this overstatement in net income, we expect stockholders' equity to be also overstated. So 4 things would be affected. Expenses would be understated, net income would be overstated, liabilities would be understated, and stockholders' equity would be overstated. There's a checkup corner. I would like you to practice that. Again, it's not too difficult. It's just a journal entry based on the examples that we've done. And I really want you to spend some time to just practice this by hand. I think it's very useful. Now let's see the third kind of adjusting entries. And in this case, it's unearned revenue. Okay, so unearned revenue, here we receive the cash, but we haven't provided the service. What makes it unearned is that we didn't earn it. We didn't provide the service. It's just the client paid us in advance. So let's see an example. The December 31st unadjusted trial balance of net solutions indicate a balance in the unearned rent account of $360. So this means that the tenant paid me $360 in advance. The balance represents the receipt of 3 months rent on December 1st for December, January, and February. So if simple math, 360 divided by these 3 months, it's going to be $120 per month. At the end of December, 1 month rent has been earned. So now let's do an adjusting entry to record the earned rent revenue. So we need to get rid of the liability, which is the unearned rent account. We're going to debit that account, and this is why we see here unearned rent on the debit side, and then we recognize the rent revenue on the credit side. Remember, rent revenue, they like the credit side because they are revenues, and revenues, they like the credit side. When I debit the liability, which is the unearned rent, and please remember, unearned rent is a liability account. When I debit that, this means that I'm reducing it because liabilities, they're normally on the credit side. When I'm debiting them, I'm reducing them. So you can see here that we had the $120 because this is the amount of rent revenue that we earned. So what happens here is the unearned rent went down because the liability went down, and the rent revenue on the other side went up, which also has an indirect effect on stockholders' equity, which also increases stockholders' equity. So let's see, what if I forgot about recording this transaction? What's going to happen? Revenue is going to be understated because I have rent revenue. If I forgot to record it, then I missed it, so it's going to be understated. Net income would be understated. Expenses is not affected because as you can see here, we didn't record any expense, so expense is not going to be affected. For the balance sheet, again, assets is not affected with this adjusting entry, but if I forgot to record this adjusting entry, my liabilities would be overstated. And because net income was understated, stockholders' equity would be understated. So again, 4 accounts would be affected, or 4 parts of the income statement and balance sheet would be affected. Revenues would be understated, net income would be also understated, liabilities would be overstated because I wouldn't have reduced my liability, so it would be overstated, and stockholders' equity would be understated because I didn't include the net income. Let's see another example, but this time it's about prepaid expenses, like supplies. So the December 31st, 2017 unadjusted trial balance of net solutions indicate a balance in the supplies account of $2,000. Some of these supplies were used during December and some are still on hand, not used. Assuming that on December 31st, the amount of supplies on hand is $760. The amount to be transferred from the asset account to the expense account is computed as follows. So the computation is very important. So you can see that we started the month where we had $2,000 worth of supplies. So we had in the unadjusted trial balance, we had $2,000 worth of supplies. By the end of the month, December 31st, we look at what we have and it's only $760. Can you figure out how much we used? Of course, it's the difference. We started with $2,000, the leftovers are $760, so we used $1,240 worth of supplies. So that's the amount of supplies expense that we are going to use for our adjusting entry. So let's see how the adjusting entry would look like. Very standard, I want to use the right word here. It's just very predictable. We expect to see, once we have the supplies adjusting entry, it always looks that way. We debit supplies expense and we credit supplies. Supplies expense is an income statement account. Okay, it's an expense. And expenses, they are recorded on the debit side. Supplies, they're also an asset. They like the debit side, but we are taking them down. We're reducing them. Because we're reducing them, we record them on the opposite side of their nature, which is the credit side. So we debited supplies expense, credited supplies for the $1,240. One thing I want to remind you, in every single journal entry, the debit and credit should always equal. So I don't expect to see anybody recording two different values, because I've seen it in the past. Some students would record $760 on the credit and $1,240 on the debit. That's not correct. We are recording how much supplies we've used, and that's going to be debiting supplies expense, and we credit the supplies. So we expect supplies expense to go up, and that's based on the $1,240 here. And assets, which are supplies, are going to go down. So as supplies expense, they go on the debit side. When we reduce the supplies, they go on the credit side. It's an asset. And remember, we're still meeting the three requirements or conditions of adjusting entry. December 31st, end of period. We have an income statement account, which is a supplies expense. We have the supplies, which is an asset account, which is a balance sheet account. And we don't have any cash. So all three conditions are met. Let's see another prepaid expense example, which is prepaid insurance. The December 31st, 2017 unadjusted trial balance of Debt Solutions indicate a balance in the prepaid insurance account of $2,400. The debit balance of $2,400 represents the December 1st prepayment of insurance for how many months? For a year, 12 months. At the end of December, the insurance expense account is increased or debited, and the prepaid insurance account is decreased or credited by $200. How did we get this $200? It's for only 1 month that we incurred an expense for. Remember, we paid $2,400 for a 1-year policy, 12 months. And it started on December 1st. So by December 31st, we used 1 month. So $2,400 divided by 12 months, that's $200 per month. And we only used 1 month. So this is where we need to make an adjusting entry for the $200. So on December 31st, we debit insurance expense and we credit prepaid insurance. Very similar to supplies expense and supplies. We debit prepaid insurance and we credit prepaid, we debit the insurance expense and we credit prepaid insurance for $200, which is 1/12 of the $2,400 premium that we paid for the full year. So we expect here insurance expense to go up and then prepaid insurance, which is an asset, to go down. So what if we forgot to record these transactions? And by the way, prepaid insurance, that's a deferred expense. So we paid before we received the service. So if the preceding adjustments for supplies and insurance are not recorded, the financial statement prepared as of December would be misstated. In what way? Revenues are not going to be affected, but expenses would be understated because we won't be recording these expenses. And then for net income, it would be overstated because it usually works opposite to expenses. It's not usually, it always goes opposite to expenses. And then for the balance sheet, the assets would be overstated because our prepaid insurance and our prepaid supplies are going to be kept at its original value without reducing them. So that would make them overstated. Liabilities are not going to be affected, but our stockholders' equity would be overstated because the net income was overstated. So error number 1 indicate the effect of understated expenses on assets, and error number 2 indicate the effect of the overstated net income on stockholders' equity. And I told you the relationship is always the same between net income, and stockholders' equity. Something easy to remember. So let me stop here, and in the next video we're going to cover our discussion about depreciation, which is very easy, and then we'll wrap up the chapter. Thank you for listening.